In today's video, I'm going to be breaking down a lot of different options that you may have if you're looking to have nice, steady monthly income from ETFs and stocks. This is definitely a portfolio that can work right now, in my opinion. Let's get down and let's check this out. So this first stock that I'm going to be breaking down is Canadian Apartment Properties Real Estate Investment Trust, CAR-UN TO is because it's on the TSX. From there, we look at the dividend, and it's a 2.82% dividend currently at the time of making this video, and the average volume is 520,000 shares every single day on average. That is absolutely amazing. The PE ratio is also not super crazy either, which is nice to see. Now, if we look at the financials annually, it actually looks kind of interesting. Because before the pandemic, the actual earnings slightly decreased while the revenue was up. Now, if we look year over year all the way through, the revenue continued to grow, even technically when it came to 2020, which is absolutely amazing. However, the earnings were absolutely spectacular when it came to, of course, 2021. This is something that I did predict happening with a lot of different REITs a little while ago, about a year to a year and a half ago, mainly because of 2020 and the pandemic. Between those 2.5 years, that of course this was foreseeable when it came to REIT stocks. Now, what does this ETF do? Well, it is the largest real estate investment trust and has 57,000 suites, including townhomes, manufactured housing sites in Canada, and indirectly through its investments overseas in the Netherlands. So of course, this is a very interesting REIT. Something else to also keep in mind is the fact that when we're looking at housing, apartments and such, what we're looking at is the fact that, of course, when there's a recession, which is what we technically had. When we look at a recession, a lot of people lose their housing. They can't afford to pay rent. And when that happens, they may have been living on that apartment or that townhouse for maybe 4 years, 8 years, 10 years, 12, maybe even longer. And if that's the case and they lose that apartment, that owner of that apartment could only increase the rent only by a small percentage every year. There's laws in Canada that they can't exceed a certain amount. While if that tenant leaves, now if that owner did a little bit of an upgrade to that apartment, he can now charge what market value is, which could be anywhere from 10 to 40 to even 80 or even 200% higher than what that original tenant was paying. I know this because I knew an old guy who used to own about 80 different apartments in this, and I'm talking about buildings, not just apartment little squares. I'm talking about buildings themselves. He used to own a ton of them in this local area around Toronto, Hamilton, Niagara, and all the way through. And that's what he told me when I was in my early 20s. He said to get into real estate. I didn't, but he said get into real estate because the best time to get into real estate is during a recession. And the best time to or at least the best time to own apartments is after a recession, because you lost all those tenants. You can now up the price of the apartment itself, and then now instead of maybe getting $1,000 a month, now you're getting $2,200 a month. So because of that, that is the best time to actually buy into REITs, is during a recession, because at that point they're at the lowest point and there's only up to go as long as that company doesn't go under. Now, over the past 5 years, it's done extremely well. We, of course, had the virus there, and now there's worries of a recession happening again, so that is why it is currently going down. This would be actually a pretty good time to start slowly buying into the REITs because they're having this pullback, and most of them are. Their dividend obviously gets paid every single month, and they just recently increased their dividend as well, which is something that I personally always look for. Next, with the whole idea behind monthly income, we're going to be looking at the BMO Covered Call Technology ETF, ZWT. Tech, you want to be diverse, and this is one way that you could be diverse. Tech doesn't generally pay a high yield. This, of course, on Yahoo shows an A. That's a lie. It's just because it hasn't been out for a year yet, so they have no no numbers for yield right now. However, they do pay roughly around 5.5 to 6%, and it is paid monthly. The average volume is not very high, and the expense ratio is 0.65, which is a bit high for ETFs, but when it comes to covered call ETFs, it's actually about average and maybe slightly on the lower side. And if you don't know what a covered call ETF is, it's basically a company like an ETF will hold a stock, for example, Apple, and then the covered call strategy behind it is Apple only gives you less than 1% dividend. Well, if you want to have a higher dividend, you can get a higher yield, not necessarily dividend. Don't worry about it. It's just tax purposes, it's called something else. But you have Apple, and now let's say you want to make some extra yield on holding that stock. You can sell options, call options against that stock. And then when that happens, you can collect that premium. If that option is expired, useless, then you keep your stock, you keep your premium, and now that premium is your yield, and you can make some extra money that way. Now, just like all covered, or not covered call, I was about to say that all technology stocks in the beginning of the year, it went really well. Lately, technology has not done so well. It looks like it's starting to at least level out, so it's kind of interesting at this point. If you were looking to invest in something like this or into any tech stock, I would definitely say not to do the whole whack load of stock at once. Definitely buy in slowly at this point. We've had a drastic pullback. You don't want to go all in and have it tank even more. You really want to buy in slowly at this point in time, in my opinion. It does pay 13 cents per share every single month. And its top holdings is Apple, Microsoft, Facebook, some of the largest tech companies in the entire world. Some of the ones that I really like that it's holding is Apple and Nvidia. I personally believe that those are massive companies. And of course, I have to say Alphabet because they pay 80% of my income because of YouTube. So from there, fantastic companies, but those three are kind of my favorite out of them all. Next is ZWB. ZWB is quite interesting. The reason being is because it is a covered call strategy once again. However, it holds the Canadian banks. So yes, while you are getting a 5.3% dividend, if you were to hold the banks right now, you could average somewhere around 3.5%, maybe 3.75%. So you are making more yield, but if the banks start to really explode upwards, then at that point in time, you would not be looking to hold a covered call. What you would be looking to do is hold the stocks individually. Just like every Canadian bank, it was going sideways before the virus. After the virus, it's accelerated. It's had a little bit of a downturn since then because of all of this recession talk. However, I wouldn't be necessarily worried. I usually buy bank stocks all the time, individually, not in ETFs. This is not how I hold my banks, and I do not own ZWB. However, it does seem like a good ETF if you were looking for monthly income and higher than what the banks currently pay. You're just going to be really cutting your potential upside. That's it. They did recently up their dividend, which is always nice to see, and they tend to do that with this ETF quite frequently, roughly every year. And like I was mentioning, it basically holds all of the banks. So of course it holds ZEB, which is their own ETF that holds the banks equally. And then they hold the bank stocks individually as well. And then they do sell the call options against them. Now, when you're looking at this, personally, I would rather just own the banks up straight up, and that way I don't have to worry about MERs and things like that, and I'll make even more money because it's not in a covered call strategy if there's upside to the banks. However, if we find ourselves like we found ourselves before the virus, where the banks were basically trading sideways, that is when you would want to hold the covered call because the banks aren't moving anywhere, you're protected from the downside, and you're making an increased amount of money from the covered call options. So that's when you would want to play this, is when the banks are going sideways like before the virus. Now, while I am a dividend investor, I also want to see some growth too. I want my underlying assets that I'm holding to be worth more than what inflation is currently trying to kill me with. So because of that, right now, I want my stocks, all of them, to be growing at least a minimum of 7 to 10% this year, which is why I'm getting into maybe a little bit more of a riskier strategy when it comes to weed stocks, as well as some other tech stocks that I'm not going to mention just yet. I want to see how they work out before I get all the way into them. I'm not all the way into certain stocks right now. I have money allocated that I think I will be putting into more stocks that are on the tech side because I think that there's some growth there. But when it comes to dividend, this is definitely a good way to look at a way of investing. Is growth plus big dividend. Next is ZRE, going back to the REIT idea because, of course, they do pay every single month. They pay not that bad either at 4.2%. Volume is okay, but what we are getting here is, of course, the fact that we're coming out of a recession. We could be in a recession right now even. We don't know. However, coming out of recessions, generally the REITs are the best way to be. This has an MER of 0.6%. This has had strong growth before the virus. This would have been a fantastic time to buy in. I didn't. And, of course, it's been doing quite well since then. Really volatile, so it's a good time to kind of buy in at the dips. And they tend to pay 9 cents a share for quite a long time. And the top holdings in this ETF are these. RealCan, I personally don't feel is going to be a fantastic option into the future with more online shopping. However, with more online shopping is industrial REITs. And I'm going to tell you a little small story about that right now. I am currently trying to find a warehouse to be able to build basketball courts. And I'm not just talking about my own self at my own house. I'm talking about trying to build something massive because there is a massive shortage of indoor basketball courts in this area. The team that I coach is having ridiculous struggles because their building is currently under renovation, and there is ridiculous amount of teams that just need court time, and there just is not enough courts that are currently servicing the area. So I am currently trying to find warehouses, and it's impossible to find warehouses that are of any good size to hold 3 to 4 basketball courts. So because of that, I'm going to say that right now, considering that's a Canadian company, because there is a shortage of good-sized warehouses, they are going to be probably doing really well over the near term. Anyways, that is my video for the day. I hope that you've enjoyed. I hope that these stocks or ETFs might help you out. If they do, hit that like button, subscribe, and I'll see you guys again next time. Remember, always do your own research. Never trust a random person online, especially the Bitcoin people down below in the comments.